Good morning, everybody. Welcome. Hope your Thursday is off to a great start. Mine is as well. I guess I should be calling the first part of these streams now the lecture portion, or the I don't know, the blackboard portion, while I run through some charts. But I definitely want to keep it interactive, for those of you that like to interact and throw in questions. And if you want to see something with some charts, let me know. But one question that came up yesterday, which is also all around the news these days, is the question of interest. Okay, interest on the debt, particularly the United States debt. And I've done some charts on this before, but I have a good one that is all updated and ready to show you. So let's do it. Here's the U.S. federal debt over, 230 years. I'm not going to go through the whole history, but remember, debt always explodes during wartime and uncertainty. You can see it did here during the Civil War. Then it went down, and even as it was going down, GDP was flying for the United States, some of the fastest growth ever. So you don't need debt to grow. I'm definitely not a debt dove or someone that says it's great to have debt. But I also feel like when I show some charts like these, somehow I come across as a little bit of an apologist for government spending too much money, when in reality, what I'm trying to just show is the reality. This stuff can go on for a lot longer than we think, even as the news cycle gets more and more hysterical every week. So again, when the U.S. entered World War I, they raised a lot of debt to do it. When the U.S. entered World War II, they raised a lot of debt to do it. What the U.S. found here after the gold standard ended was they could continue to raise debt and finance deficits. Not trade deficits, although they had trade deficits, but fiscal deficits. People would prefer to have dollars across the world, and that could subsidize, because there was still such a strong demand for the dollar, that could subsidize deficits, what almost seemed like indefinitely, or a new normal. Okay? Let's talk about interest now, interest on the debt. At the moment, I don't have an actual chart for the interest. Probably should, but you can look it up. The trailing 12-month run rate of interest right now for the federal government of the United States is $1.1 trillion. Okay, it's about the size of the military budget. $1.1 trillion a year. However, and again, I always want to caution, I'm not being an apologist for profligate spending by any government. We need to ask the question of if that looks abnormal compared to other times in history. Okay. And another thing we're going to analyze is how can the central bank, which is monetary policy of the United States and affects the value of the dollar, how does that affect the ability to finance deficits? Okay. So this is the federal debt again, right? And we're also going to talk about this, which is basically the central bank's holdings of United States government debt. Okay, so this right here, when we talk about, we have to print the deficit, it's not always true, and I'll show you the brass tacks of that. Okay, so we're going to go to this chart now. This is a different thing. All right, this is everything on this chart is per $1 of tax. Per $1 of tax received by the federal government. All right, and it's smoothed out. Okay, so it's not monthly tax. It's over a trailing 12-month period, rolling. Okay, so what it's saying here, and now this is the deficit. Okay, so when you have a deficit, obviously you're spending more than you take in. Okay, so what this is saying here, for example, is right here in December 1991. This is the exact day that the Soviet Union dissolved. United States, at this point, from December 1990 to December 1991, spent $1. They got taxes worth $1, right? I mean, $1 is a denominator here. For every dollar worth of taxes, they also spent $1 and 41 cents more. Okay, that's what this chart is saying. It's showing you the deficit in terms of $1 tax. Okay, so they spent 41 cents over every dollar received in tax in 1991, leading up to this period. And then it was a little bit high as well in 1992 here, and then it rolled down. This is a trailing 12-month period. So from March 1994 to March 1995, they spent 22 cents over every dollar they receive in taxes. Okay, so they get $1 in taxes, they spend that dollar, right? So that's total expense. Dollar received, dollar spend, and they spend 22 cents more. Okay, so this is another way of looking at the deficit. This is also a positive number. Okay, this on this chart. I'm not doing that purposefully. It's just easier to read numbers sometimes positively. But every time this this red shaded area is above zero, it adds to the national debt. Okay, that's how government works. It's very basic. There's no fancy financing. It's just we float bonds if we can't pay our bills. That's it. All right, so we put those treasury bills out there. People buy them. With the money they buy them, we pay our bills. So every time, every month here where this is above zero, the national debt is increasing. Okay, so we can obviously zero in on right here. What's going on here? This is the Clinton years. And it really happened really at the end of his term. Okay, even though kind of an accounting trick, I'm backing into this another way. I'm using the national debt, changing the national debt. Some people like to say he balanced the budget earlier on before September 2000. It's a different way of looking at the same thing. Bottom line is definitely the Clinton years allowed for low deficit spending and even deficit surpluses here by the end of his term in 2000. Bush came in here January 2001. We can even zoom into 9/11. All right, so here's 9/11. It's not like Bush was, the Republican was following the divided Congress's lead. Even right after, this was before major war spending started. It was already creeping back up. Okay, so it's very tempting to run deficits if you're a government. Very tempting. But as we had here, obviously a Republican Congress, Democratic president, that was generally known as a pretty good time. This was when I was growing up in the 90s. Pretty good time, and on a trailing 12-month basis, the United States was always spending a little bit less each year. Still running deficits most of the time, but they were spending less, okay? So obviously here you got the Great Depression. These are huge run-ups in the deficit. And let's pick this maxes out here. Why is my tooltip not stopping me to zoom in, I guess? Why is that doing that? I have no idea. I'm maxing this chart at 100 cents. Usually I could connect the dots there, but anyway, maybe it's because I don't have this. Yeah, here's the average. Okay, I was gonna do a more fancy intro for the average, but here's the average deficit over the entire period that I got data, and because of the Federal Reserve starting in 1913, I'm going back to basically the founding of the Federal Reserve here. So during the depths of both the Great Depression and into World War II, the U.S. government at its peak was deficit spending $3 per every dollar's worth of tax. Again, so remember what that means is 300 cents there, $3. They would earn, for every dollar of tax earned, they would spend $1 and then spend $3 on top of it. Okay, so there is a history, at least in the United States, of spending during wartime a lot. And of course, how do you do that if you don't have any money? You float bonds, war bonds, treasury bonds, bills, notes, all these things help finance this deficit. Okay, actually, here during the roaring 20s, this is a surplus. Okay, so they're paying down debt during this period between World War I and just before the Nazis took power in Germany. It was a really peaceful time, at least for the United States, the old roaring 20s. They were paying down debt, and then here they paid down a little bit of debt right after the war. But generally, obviously, you can see that the United States deficit spends, on average, 28 cents on every dollar of tax. Okay? So on average, over the last 100 years, the United States collects a dollar in tax, spends that dollar, and then spends 28 cents more. So I think this is another helpful way to look at how deficit spending really works. Okay. Before I get to interest, I want to talk about the money print because money printing is important, right? We go back to here. I want to talk about this. This is essentially the monetary base. It's the asset side of the central bank's balance sheet. But this is the, assets equal liabilities. So the central bank, as an asset, buys government bonds and holds them. On the liability side, they just print money, ex nihilo. But they, it's not like they print money and don't have anything. They do hold government bonds. Again, I'm not defending the practice. It's happened for millennia. It's how it works. Okay? So now that we're looking at this thing in a rolling, trailing 12-month basis here, over 100 years, let's look at how much the central bank has helped deficit spending. Okay, so that's going to be green peaks right here. Good morning, Yuri. Hope you're very well. Congratulations on the amazing intelligence victory for Ukraine on Sunday. So here's basically when the central bank has stepped in to subsidize deficits for the federal government. Obviously, you could say they do it all the time because you see the green line is generally positive, and positive here is actually a negative, and it's all in terms of $1 tax. But these big increases, these big mountains of green here, is when the central bank is printing money to cover the deficit. So they did it during the Great Depression. Even though Ben Bernanke said they didn't do enough, they did. They did actually do some printing. They did it during World War II. They did it all the time, really, through the Great Moderation period. And then big ones here, QE 1, 2, and 3. And then the old pandemic. If you put that back on this scale, which is a balance, all right, so remember, these are trailing 12 months, okay, trailing 12 months, you'll get this, I can show you the balance then again, so the whale of the central bank in terms of the federal government. This is the same thing. This is the size of the Federal Reserve in terms of debt that they own or money that they print. It's this green, dark green right here, dark green, okay, over the entire history of the Federal Reserve. So you see how it works now, all right? So when you have these big mounds of green, these major printing periods, you're creating money. You're creating central bank money, and you're subsidizing the deficit by buying bonds. But you don't always do it. Sometimes you destroy money, okay? So they destroyed money from mid-2014, right, about here. They started to go down, and negative into 2015, and all the way really negative. They were taking bonds off their balance sheet just before the old pandemic. And they didn't do it that well because we had the repo spike in September 2019, which was a huge red flag. Big money print, and now we've been destroying money. the Federal Reserve, other central banks around the world have been destroying money over the last 3 years. But we can see the rate of destruction is slowing. Whoops. I have to do that again. Sorry. Even if you look at it here, same idea. This is the balance of bonds. Federal Reserve holds. You see that it's slowing, right? The slope was steeper here. Now it's slowing down. I have to, give me a second. I have to reset this. Love it when you press buttons you didn't mean to and then lose your... Good morning, Gio. Good morning, Roman. Yes, Yuri, I hope they get the message as well. Something tells me they won't. Okay, so going back here, looking at the debt, looking at interest. We're going to get to interest, okay? You see I'm just taking everything off now. This is where I was. Okay. And then obviously we didn't talk about recent years, but you know, there's been some big spending years. Doesn't matter Republican or Democrat. All right, here were the Bush years. Obama came in, inherited a crisis from old George W. and Alan Greenspan, more importantly. Big spending during the Obama years, spending, you know, right here. At this point, remember the scale maxes out at 100 cents. Okay, so right there, August 2009, the federal government deficit spent an entire dollar. That means they received $1 in tax, spent the dollar, and then spent another dollar on top. Okay, so very high deficit spending, but they also got help from Ben Bernanke right here. Printed a lot of money to subsidize that spending. Printed at this point around the same, well, let's go to the same period. Why can't I find it? There it is. August 2009, at that moment, Ben Bernanke, instead of just spending a whole dollar, they printed 47 cents to help that deficit spend. Okay? So this is, it's not like the central bank prints all the time and that's all they know how to do. Again, I'm not defending them. I'm just saying they do destroy money at sometimes. They destroyed money here. There's a little bit of a caveat to this because right here they were actually bailing out Main Street. This was the thick of the crisis. They were selling government bonds, but they were also buying corporate bonds, which they don't typically do. And I'm not showing all that on this chart, so it gets a little bit complicated, but they didn't completely destroy money here. But most of the time, government bonds are the vast majority of their balance sheet. When you see this green negative mountains, they're destroying money. When it's positive, they're creating money. And you can see they try to like play with it sometimes. Like if you zoom in here, right, post-World War II. All right, so money is being destroyed and debt was being destroyed. Then right here, they decided, okay, let's destroy some money but create some debt. And then they're like, well, let's change it around. Let's create some money and destroy some debt. So they like to experiment. It's not very scientific. They just like to change. They like to change it up. And then to show you the average of that, of the money printing, I have the green. So let's take off the noise. Let's take off the mountains for the deficit. Let's take off the mountains for the print. Remember, we're always speaking in terms of $1 of tax. So what do we have? For every dollar of tax, the federal government, on average, spends $1.28 more. And then regardless, out of that 128 or even $1, whatever you want to look at it, 4% is printed on average. It's actually not that much. On a trailing 12-month basis, only 4 cents on the dollar is printed. Now let's look at interest. All right, so I'm going to take off. So interest is part of this whole dollar equation, dollar of tax. And I'm going to show that now. That's average. No, I'll show this one. Let's take off the other stuff. Okay, so this is very simple. This is same idea. For every dollar of tax, how much is interest payments? Remember I said it's 1.1 trillion. Good morning, Anders. Good morning. 1.1 trillion is the interest payments right now on a rolling trailing 12-month basis, 1.1 trillion. But let's look at how much that is historically. Well, right off the bat, you can see it's not a high. Again, I'm not defending it, just trying to put things into perspective here. You have to look at it on cents on the dollar. So right now, for every dollar's worth of tax that the government receives, interest is 23 cents. It's definitely high. You can see it's a high number. What was it during the Great Moderation? This was actually good days, okay? And remember, interest rates were higher here, debt was lower. Got up to 29 cents, almost 30 cents on the dollar. But that wasn't even the high for the data that I have. Unfortunately, I don't have data older than this. Great Depression period, 60 cents on the dollar, interest payments. So we're not in Great Depression level territories, even though you talk about $1 trillion worth of interest. That's what I think is missing in this discussion. Let's look at the average, 20 cents on the dollar. So we are above average. It's not a good thing. You want to not pay as little interest as you can on your national debt, on any debt, obviously. If you're a debtor, if you're a creditor, you want a little bit more. But this is how it looks relative to the most important thing, which is the tax that the government receives. So let's again take out the noise. Let's just put everything back. The simple ones, the averages. Let's take out this. Okay, so what is this? What are these three bars saying on average? Okay, the red line is saying on average, the government receives, for every dollar in tax the government receives, they spend that dollar and 28 cents more. That's the red line. Interest, again, this is out of the dollar. Okay, so for every 20 cents out of a dollar in tax, it's interest on average. And then the print, which is something that helps sort of dampen the effect of deficits. Of course, it does add for inflationary pressures. It's 4 cents on the dollar. It's actually not that much. The money print is not the main story of the Treasury. It's definitely one of the most important, how do I say that? It's definitely unimportant feature. But if you look at it as far as cents on the dollar received, the federal government only gets a 4% boost, so to speak. If you look at hyperinflationary nations, I'm sure that this number converges on 100 cents on the dollar, right? It's just all money printing with interest. So that's the picture. It's again, I'm not saying we're a long way from crisis, but as far as the idea of this interest burden being something historically untenable, it's actually not. We'll see. Every day in the news cycle, we talk about something new, how the world is going to flip into the sun, but we're not at historical crazy levels. Yes, the print is not that big a deal. I shouldn't say it. I know I take these words back. It is important. It's always important. People watch what the Federal Reserve does, but the United States has room to grow. Let me show you the room to grow. So basically, this is the print balance. Let me take off. Let me put this back on. This is just the money print. Let's put the deficit just to show. Take off interest. Okay, so again, the red mountains are when the government is spending more than it takes in tax, which is almost always. Okay. During COVID, it went up to 125 cents, August 2020. Again, that meant government takes in the dollars worth of tax, spends the dollar, and spends $1.25 more. They don't do this all the time constantly, but during certain periods they do. Okay, but the sum of the green mountains now, which is the print, will get the black line. Okay, and that's the same dark green area that's here in this chart. Same thing. We've talked about this a lot. Holdings of the central bank, there's this percentage, right? Got up to 30%, now it's down to 18%. It's the same percentage here, percent on the dollar. This is cents on the dollar of government debt. The black line. Not on dollar of tax. That doesn't really make sense. But this is cents on the dollar of government debt. It's the same percentage as this green line here. Okay. So my point is, and if you do a little regression, which is not that strong of a regression, but it's exponential, right? As most stuff is in the TradFi world. You know, if the Federal Reserve wanted to keep on their trend, they're well under trend, and they have plenty of room to print. I'm not apologizing for them. I'm just saying, if you want to think about tomorrow, the next day, next month, next year, they have room to print. Now, if the stock market goes down and treasury markets continue to go up, Scott Bessent might have a problem. Trade policy continues to be bad, might have a problem, but it's not like they don't have room to do stuff, which is always good for Bitcoin. Yeah, so let me see if I have debt to GDP. I knew that was going to be a question, and I don't think I have it ready, to be honest. So the most important thing I think out of this chart, though, are these averages. So again, we're well below average on the print. I know it's like crazy amounts of things on the chart here, and take them all off. A lot of noise. But if you want to come down to one number, Americans like one number or three numbers, right? You typically spend 28 cents on the dollar more than you receive in tax. 20% of your tax is always going to interest. And we're above that now. We're rising above that. We're at 23 cents. Okay, so that's not great. And the Federal Reserve subsidizes to the tune of 4 cents on the dollar, although the extremes are huge, right? Huge mountains above that. But if you want to look at the average, it's 4 cents on the dollar. So they're hardly scientific. They're hardly predictable. They can be a bit erratic. And if this was like the great days of America, well, when it doesn't seem like we're sticking around here. You know, even though you had the Vietnam War here, you still had the great moderation in the 80s, 90s. Deficit spending's falling. As I'm growing up, you know, people are happy. It's a new world. Soviet Union ended. All that stuff is changing. I don't have a chart, honestly, at the moment. Unfortunately, Joe, I need to get some basic ones there. And also with Britain. I wanted to put Britain on there. So that's the interest, and that's the debt situation of the government. Again, this stuff is like an oil tanker. It's massive. It's very difficult to change. Central bank can allow it to be a bit more flexible, so to speak. But none of this has anything to do with Bitcoin's purchasing power. What has to do with Bitcoin's purchasing power, in my mind, is the power curve, network adoption. I added something here, which I think this will be interesting. I put these mountains here. You can see them here, 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 and here. This is how many days the price is into the 90th percentile. Right? So just the lowest percentile on this band. All right. When we start to get into silly season, obviously we haven't even hit that here and not even anywhere close to the 90th percentile move. Okay, so let's count them. Let's go to the beginning here. This is kind of, they look weird zoomed in, but it's just simply cumulative days. All right, so 56 days here, 2011, where we were well above trend. Almost 2 months. Okay, let's look at 2013. First big extended one. Happened a little bit at the beginning of the year, okay, but not, we can still count them. So in the beginning of the year, it was 19 days, then it has to reset here, another 15 days, let's just say a month, and 10, 7, say 2 months again. Yeah, I mean 2 months. Obviously, I could just eye this in the tooltip, but I want to use these little counters. Let's zoom in here. So again, if it drops out of the 90th, it resets the counter. So you get these weird mountains. 11 days, 18 days, let's call it a month. 84 days, let's call it 3 months. That's 4 months. And another month, 5 months. 5 months with a few days dipping out of our Goldilocks zone. 5 months in 2017, 2021. I have a couple days here. It's very quick. In January, 5 days, whatever. We can count it. We can not. 5, 7 days. Then just the big one here, a cumulative period of 99 days, ending May 2021. Okay, call it 3 months. And this part is interesting, right? So when the double top barely scratched the surface here, which if you can use this to your advantage when it dips out, be careful. 11 dipped out back to 7, so a month, but that was already dipping in and out of the our nice zone here 3 times. And the third time it didn't come back. So if you think about it that way, all of these predictions, all of these metrics, at best, we're looking at 5 months, probably more like 3 months. What was 2021 again? I already forgot myself. It was 3, right? 99. 2017 was pretty good, pretty extended. Hello, sir. So, yeah, I have to answer this question a lot. These are all drawn locally. I change them every morning. I just don't have a website with this up. I mean, I have my website, which you can go to, and we only have the power curve itself, which is here, right there. There's only one chart up at the moment. It's a lot more basic than what I have, but this is a whole local thing that I have. This is why I make videos. It's just I change these, all these charts I change all the time, and it's just it's too much to host. So so I don't know what you guys think about that. 3 to 5 months is probably what we're looking at as we get to the end of the year here. Oops. As we talked about, I don't think this happens, this happens, this happens, this happens, or this happens. I think even that. Maybe that, but. So getting up to the 95th percentile, $330,000 Bitcoin. You know, it's impossible to predict the future. It would be interesting if we had just a slow build. Some people talk about the slow build, but pendulums tend to swing. So this is another, I think, a helpful tool we can use if and when the bull arrives. Start looking at these mountains. This was a fairly reliable, 99 days. And if you, did some paring down of, some gains, buy gold if you want. If you don't want dollars, sell for dollars. Yeah, you got to pay tax or whatever, however you want to do it. But buy gold. You don't have to keep dollars or euros. It could be something like this, where we get some fake outs. Got to reset the counter. I remember when Bitcoin, I was with my old buddy Fernando in New York around this time. I remember Bitcoin going to $5,000 for the first time. This is really when the euphoria felt like, and that was exactly around the 90th percentile. But it might fake you out. Might have to reset the counter. Perhaps another good rule of thumb here is if we look at this counter and it gets pretty big, right? Like this one obviously went up to nearly 3 months. Could be another warning sign. Could be. What else do I have? Why is this looking like this? No idea. Probably because of, I'll have to check that again. There's another reason. When charts are not drawing correctly, I have to get in really quickly and fix. Another reason why I'm just not hosting all this stuff. Remember, if you want to understand why this curve is a straight line on log scale, you need to look at this last column. Bitcoin doubles every 12 or 13% increase in time of the network, okay, measured by days. This is what proportional power growth means. You can find it all in this table. It's not constant like a stock or gold or whatever, a bond, with a constant fixed yield to maturity or IRR, which people chase, 10, 15% per year. It is power. Is this right? So let me know what you guys think. If you want to look at something else, I've been updating my monetary base stuff. Takes me a couple days every quarter. Go through the top 50 central banks in the world to get let me see if it's here. Da-da-da-da-da. Are you updating? Yes. Okay. So Yeah, that's totally true, Roman. I mean, the most nerve-wracking part is on the way up. And then as you come down here, you're hoping bounces back up, but nobody knows. You know, I mean, obviously could have, and nobody knows when that. But something like this is, I think, actually helpful if you can. If we get a sustained period of a pretty big mountain, and we already know now that the mountains, as a max, would be something like 99 days. Doesn't mean the next time that'll be the biggest mountain. But if you get a cumulative growth above this 90th percentile, uh, it could be a good sign. And by the way, like price might not, if you're planning on sort of cashing in a little bit here, so to speak, or cashing out of Bitcoin, going into some dirty fiat for a while, you might not obviously be getting the price you want relative to the top. I mean, we're very briefly November, December, close to $1,200 intraday here. This is just daily close. So you're not going to see it exactly. Then all of a sudden here, by the time we're out, it's already down to $600. I could tighten this up if people really want to see the counter differently, right? I'm counting from this. I'm counting from this bottom line. I could count it from here, in which case the mountain would be much quicker. It would only last about 40 days. And if we go till today, did we even hit it? Yeah, we didn't even hit it. So that's why 98th isn't a great one. It did hit it here for 60 days above the 90th, out at the 98th. But if you tried that method here, that wouldn't even work, right? Because we did not hit, based on my bands, on my regressions, we did not hit the 98th percentile. So you'd have to get a different method to help you, to help the Malox moments. I wanted to show this again. Same one we've been talking about, right? But I got most of the data in now through May. It's a little bit higher than I thought, actually. 43.4 trillion on the green. I'm looking at the green. You remember yesterday we were at 4.9. We looked at this. I think it was 4.9% in May. So I got more data in. I thought it would be even lower than this. But it's 4.8. So it's not bad. Bitcoin is doing just fine. Yeah, I think you're right. It's just slowly iterating on stuff I've done. Look, this would have helped me. I mean, this would have helped me here. It's not guaranteed that we don't have another, like, this type of a peak this time, right? I mean, you got the presidential administration all in on Bitcoin. Who knows? You could definitely get above the 98th this time around. Yeah. So that has a lot to do. Your comment here obviously has a lot to do with the ETFs, which came last year. This was a very big push. Pushed us up to the trend. And isn't that wild? Think about that. Again, we're at a $30,000 a year run rate on the power curve. So the power curve itself was 65,000 a year ago. a little over a year ago. Now it's 100,000. Thinking of that other valuation I did, which was days, measuring the rate of change of the day, the month, the year, and seeing where the daily goes. But yeah, this is true. You know, the short-term stuff is political, right? So this is 10 years of frustration, pent-up frustration from Wall Street on not being able to get in easily to the Bitcoin game. And Gensler finally caved a year ago, January, and we boomed. I do not have this. Pi cycle, no. 350 DMA times 2, no. I can try to make these, replicate them, but I do not have them handy or anything. It's a good point. And, you know, I say it a lot. I'm not like a trader. This is more long-term, trying to get the whole macro view backing out a little bit. But I'm always keen to look at more things, you know, if I can, especially if they're sort of move around these regression trend lines, because that's what I think is most interesting. Yeah. I think 18 months after the halving is a very good number. I could also do some numbers there, like obviously just checking the halvings themselves. I'm doing a countdown, right, from the tops. It's a little bit more artsy. In my opinion, this is less artsy, but I take the point. What do you mean 1121? Is that a typo? Right here. This is 1121 usually. Okay. Let me see what we have here. But anyway, the point I just wanted to say is as of last quarter, with the money that's printed, we're, you know, right on track from, you know, even the little changes that I did yesterday in my database for the fiat monetary base, that is central bank money. It's coming in around, you know, May 2043. $155 trillion. People are actually using it, Yuri. You can go to different sites to see, but the Lightning Network is booming. Let's see what I got here. This is a great site. So this is Lightning Network. Right there is active capacity in Bitcoin terms, 4,285 Bitcoin, 450 million. It's happening, you know, every day. Volume capacity. And I have said for a long time, I am I'm an on-chain guy. I mean, I like Lightning. I think all that stuff is awesome, but I also think it's good to have privacy in your in your in your life, and so the Lightning Network can help there. But really, what Bitcoin is competing with is this, and I don't have an update on this. Unfortunately, this is something I wanted to do. This is what Bitcoin is competing with. Fedwire, or this is basically how many times a year this turns over, this balance, which is the money. This is Fedwire stuff. Is this 8 trillion? It's actually not that high because you got to take out physical cash and other things, and it's really only a couple trillion, 3 trillion. 3 trillion is what is actually liquid federal funds. But if you look at these stats, which is Fedwire, and I need to show this in different ways, but this is the value. All right, this is in millions, so million, billion, trillion, 104 trillion dollars transferred in April. Multiply that by 12. All right, that's 1.2 quadrillion. Okay, 1,000 trillion is a quadrillion. So it's 1.2. This is in the month, right? 100 trillion per month. Okay, growing constantly. 1.2 quadrillion per year. Bitcoin can do an infinite amount per year. The price just has to rise. So Bitcoin is doing a few trillion a year at the moment. I don't actually know off the top of my head. Let's find it. I have charts for all these too. Sorry. Finding it. Yeah, it's roughly 5 trillion, 4 to 5 trillion at the moment. So a year. Okay, so Fedwire, which is the base layer of the entire financial system, and it's only one base layer, by the way. There's the UK has their own base layer, Europe has their own base layer, Euroclear. The UK is called CHIPS, I believe. They do 1.2 quadrillion dollars of volume a year. Bitcoin does 5 trillion. But there's nothing in Bitcoin's capacity that is stopping that. All that Bitcoin needs to do is rise in value. And it is. It is rising in value to do that. There's no network capacity that can stop Bitcoin from reaching a quadrillion dollars of transfer value a year, because the network works the same. Yeah, you're going to have higher value per volume transactions because Bitcoin network can still only do about 300,000 transactions a day, but the value can increase to any number. There's no cap on it. Yeah, interesting. So that's a good thing to check out. If the top is similar to June, oops, got a is that weather or is that just that's weather. Um, June 2020. Yeah, I'll have to check it. I'll have to try to recreate it. Yeah, that's true too. FTX going bankrupt with a 0 BTC on their books was the funniest thing ever. That's the beautiful thing about Bitcoin. We have through all the scams, we can eventually see through it with volume on chain. I need to probably show some more volume on chain things. This is an argument as old as Bitcoin, my friend. Uh, it is true. Most people buy and hold for the value, just like they do for gold or stock certificates or bonds. Um, Bitcoin still has monetary um, characteristics which are superior to any of the things I just mentioned, and even fiat money as well. So you can, you can't send your Apple portfolio to yourself or to a friend who lives in Turkey very easily if you live in the United States or Ukraine. It'd be very difficult, but it's trivial to do said thing with Bitcoin. And you also couldn't do it with gold. You couldn't do it with even fiat money that easily. Yeah, you can use something like TransferWise, but it could be held up. There could be KYC, AML. So Bitcoin is filling a different need than you're speaking about. The buying a coffee thing is an old debate in Bitcoin, and that's where the Bcashers went, the Bitcoin Cash people, because they wanted to increase the volume of transactions every 10 minutes. But the problem with doing that is you risk the security of the network, and the network of Bitcoin has chosen to not, due to the 1 megabyte block size cap, has chosen not to go that route. So it is true that you cap, at this 300, 400,000 transactions per day. But again, in terms of value, there's nothing stopping Bitcoin achieving this type of value. Which is could be a quadrillion a year. So if what Jimi Hendrix says there is true, and we are later into 2026, let's just look at the power curve. Damn. Here. No, here. Power curve 139, 98th percentile 537,000, which is lower what you said, 99th. 99th percentile is pretty high. I'll have to verify it, what you said, and do the math, but that's a 99 percentile move on the power curve, which is pretty rare. All right, 99th percentile did not happen in 2021. It happened for, now I'm counting days from start to finish. So December, to start of January. Yeah, I mean, like it happened a couple weeks. I'll take this off. Yeah, max month. And then here is probably even less. Actually, a month, about a month, yeah. So if we get these big moves, even if they're delayed, as you're saying with the pi cycle, I don't see it much more than a month touching these numbers, and probably less. Right? That would be way bigger than what happened here. Interesting though. Are you saying that these match at this point in April 2026, Jimmy? But I'll definitely look at that. Write it down just to remind myself. Also, that's a good question. I'll look at it. I'll draw it. What are we at right now? Let me pull up TradingView. Haven't done that on a stream for a while. Sorry for the dead time. I'm just trying to find it in a better way. Yeah. So obviously in April we were in huge amounts, 30 billion a day. And now we're down to 8 billion. Of course, those were just a couple days jumping. Yeah, I can imagine. Also, what is the thinking of the 350 DMA times 2? Is that something you use for other things? Again, I'm not a trader, so I'm not drawing a lot of lines on charts that way. Is that common to mix with the pi cycle? And to answer your question here, Gio, yeah, I do not think it's only ETFs that matter now. No, I don't. I think that would be unfair to the ethos of Bitcoin. I think it's obviously it's a hype for a ton of people, and Saylor is, you know, a celebrity at these conferences talking about this stuff, but I don't think so. Let's look at our buddy Rodolfo's chart at Bitcoin treasuries. Why am I so slow here? It must be my VPN today. Okay. So this is BitcoinTreasuries.net. Great site. Let me take myself off so you can see the chart. One second. So obviously, ETFs are a huge component. All right, they're the biggest slice of this chart, right, at 1.3 million coins. But governments are pretty big. Like, I don't want to rely on governments for pricing action. This public company, this Bitcoin treasury idea is pretty big. It's rising. Obviously, and Sailor is the biggest component of this by far at 580,000. Did they pair Bitcoin, by the way? No, they didn't. I thought they were up to 600,000 at some point. It's unbelievable what he has done. It is wild. Pretty legendary. And the fact that he only started this in 2020 shows how strong his conviction was. It's not like he was doing this at, $100 Bitcoin. But I don't think so. I think this is going to grow, this public company, this public treasury sort of idea, even though Sailor is 3/4 of this value. The purple here down below. It's the light purple. It is crazy. But that's not all the Bitcoin still. This total value here, like getting close to what 3.3 million Bitcoin in treasuries. At some point, whales will start to unload. That'll probably signal at the top. There's a lot of attention placed here, but I guess the best chart to really analyze this would be to show the treasury Bitcoin versus miner Bitcoin versus other that is still moving. And I don't have that data readily available. I imagine you can get it in Glassnode or these companies that are now too expensive for their data. What is definitely true, and you can see it here, right, is, okay, so here we just had sorry, one second. Sorry. All right, I'm not finding something I wanted to find, but that's too much dead time. Sorry. Uh, anyway, Saylor came in obviously right here and pretty much led the way for public companies. He was basically all of this light purple at the very bottom, right? And eventually, finally, you had the ETFs here, right? We see the massive spikes, and governments get involved too. So it is true that if you recognize that and you recognize the 2021 top, that it was more damp, perhaps you could say that all things equal, more institutional, more ability to short and to manipulate. Manipulate is not the right word I want to use. Just to dampen the price action, that we might never see these spikes again. It's totally true. There's an argument for that. But I do wonder, especially if we sort of wait on this explosion of interest, and it might not happen until, say, April 2026, as Jimi Hendrix is talking about here, then maybe you could still have a big pump, and not only from institutional demand. Are you measuring this from open interest? Or when you say the bubble is only just starting to inflate, because obviously there's a few different ways to measure that. And open interest is one of the things that I wanted to chart more. I don't have access to the data, unfortunately. But, open interest versus total Bitcoin in exchanges would be a good example, I think, of really showing that institutional bubble inflating. Let me see it. I'm looking at a coin, a different analytical chart right now, and its open interest is actually not as big as it was from April, May. But it's not too much smaller. But yeah, it's pretty small actually, only $33 billion. Excuse me. Okay. Well, these are all things that definitely should be looked at in conjunction with the old regression and power curve, which is the sort of basic scientific way I like to look at it. But yeah, I think charting exchange volume, charting transaction volume, and charting open interest are all good ways to see where we are too. I remember Nick Carter made a really good call somewhere here in April 2018. He was looking at transaction volume, right? Which we were just talking about. Right now, it's it can be 5 trillion a year, a few hundred billion a day, but it was like fell off like a cliff right here. Bitcoin transaction volume, transaction value. These names get kind of interchanged, but the value of transactions daily really fell off here. So I will try to do that as well. Overlay those things. I think they're a good indicator. But this is pretty good too, right? I mean, there's no doubt about it that when these spike up, we're in the bubble territory. You may even miss some of the bubble territory, right? Like the first spike. Well, not really. They spike up right when we're getting hot. So even if the mountains repeat and we miss a few days out of the 90th percentile, this is another decent way to look at it. So yeah, all good thoughts, guys. Thank you for that. I will try to add those to the charts. Only sort of bottom line on the money printer is, yeah, these guys are crazy. I mean, obviously you can see how crazy they've been. Powell picked up right here, right? So he's trying to fix. Picked up when did he? It was Yellen then Powell, but whatever. Let's just say it was here. They had to go crazy, but then he really wants to sort of have a Paul Volcker legacy of not excessively printing. But anytime there's a crisis, anytime there's a political crisis, it seems like they just have to print. Let me take off the other lines. Just remember, this is a pretty interesting all-time average, right? So you would think that all they do is print to cover these huge deficits, right? These are the deficits on the dollar, remember. Tax $1, spend $1, and then 28 cents more on average. But really, it just takes a little bit of printing to go way above. It takes how do I say this? By and large, the average of printing to cover the deficit is actually not that big. All through the Great Moderation, they were only printing a few cents on the dollar of tax received. And then once they decide to go crazy or there's a political crisis, they will go crazy. In either situation, Bitcoin is a good escape hatch. And this is the destruction of money. When these are lower, they are destroying the base money supply. Yeah, no, I certainly agree. I mean, you've seen the dust up that Musk and Trump are having. It's kind of funny. I'm not really a fan of either, but they just do what they do. And though I'm certainly a huge proponent of opening things up for business, which the prior administration was not doing and was pretty captured by the hard left, as they're talking about this $2 trillion big beautiful bill gets all Musk all riled up, and now he's complaining directly on his platform. All right, guys. Thank you for tuning in today. I will take some of these notes to heart, and I think it's about time. It's been you can see the iterative process here. I just sort of do what we talk about last, but I think it's time to look at some more transaction data, on-chain data, exchange data, and also this pi cycle is kind of interesting. All right, everybody. Thank you for tuning in today. Hope you have a great one. See you tomorrow.